Hello, welcome back. This is Dr. Frank again in our educational video series. The topic for this video is traditional versus Roth IRAs. Traditional IRAs and Roth IRAs both have the same contribution limits. For 2019, this year, it's $6,000. Unless you're over the age of 50, you can add an additional $1,000 for a total of $7,000. So this is a tax advantage. You have a wide range of investment options, etc. So every year, typically the government has increased the amount that you can contribute. Now, as far as 401k plans are concerned, there are typical 401ks and Roth 401ks. Taking the typical 401k, the contribution limit is $19,000 in 2019. Again, if you're 50 or older, it is a $6,000 per year catch-up, or a total of $25,000. Again, your funds grow tax deferred until they're withdrawn. Employer match is free money, so we encourage people to do the employer match. However, there are cases where maximizing your employer match may not be the best thing to do, and we'll cover that later on in another video where we talk about investment-grade life insurance as a tax-free alternative to 401k. Again, distributions made prior to age 59 and a half or 55 in some cases, depending on the type of 401k plan you have, are subject to an additional 10% premature distribution tax. There is the analog here of a 401k, and that's the 401k plan Roth contributions, which is a relatively new feature that most employers have offered. I've found out from experience that some companies don't provide the match on the Roth. Some of them do, so you have to find out which is the case for your company. And again, the contributions are after tax, so you don't get the deduction. The funds do grow tax deferred until withdrawn. The total contributions are identical to that of a regular 401k, which is $19,000 or $25,000 if you're over the age of 50. And qualified distributions are federal income tax free. This is the key thing on Roths. That is that the distributions after a 5-year holding period are tax free. Or provided that you're over the age of 59 and a half or disabled, and we'll cover that detailed in a couple examples in a couple minutes. And there are non-qualified distributions where you may have to pay a penalty of 10% if you're under the age of 59 and a half, okay? So that's what a 401k Roth is, and most companies now are offering both. Now, the Roth IRA itself is really the holy grail of investments. By that, what I mean is you're avoiding the tax time bomb of a 401k. Yes, you end up not getting the tax deduction from your paycheck, but it's the difference between paying tax on the seed, which is your monthly paycheck, versus paying tax on the harvest, which might be $1 million in your 401k. So that is why we call it the holy grail of investments, because it's tax-free. And this is a very important item. Most folks don't like required minimum distributions when they turn 70 and a half. There are no required minimum distributions on a Roth IRA. If you look at the advantages and disadvantages of traditional versus Roth IRAs, most people will probably benefit from doing some of each, okay? So I would recommend that that's the case. One other point that's very important to note is that you can do a conversion at any time from a traditional IRA and move it into a Roth IRA. But it's very important that you note that this must be done typically before you reach the age of 70 and a half. Why? Because once you reach the age of 70 and a half, and you have to take your required minimum distribution out, which is roughly 3.8% of your IRA value. So, for example, if you have $1 million IRA, you need to take out $38,000 and pay tax on it, whether you like it or not. And that money, the $38,000, cannot be converted to a Roth. If you want to do a Roth conversion after you're 70 and a half, you must take out more than the required minimum distribution. So, for example, you'd have to take out $50,000. If the RMD is say 35, then the additional $15,000 could be rolled over into a Roth. That's a very important point to know, that you must do a Roth conversion. You should really start doing it several years before you're 70 and a half. Now, as far as the distributions from a Roth, they are tax-free, as I said earlier. However, the gains must satisfy a 5-year holding period, okay? And it has to be a qualifying event in order for it to be tax-free. And a qualifying event is they're 59 and a half or older, otherwise there's a 10% penalty, or you're disabled. If you're disabled, then the 10% penalty is waived, or you have to be a first-time home buyer, and that's limited to $10,000 or on a death. So it's very important to remember that point. Now, as far as the 5-year holding period is concerned, that starts the first day of the tax year. So if you opened up a Roth on December 1st, for example, the time clock for the 5 years starts on January 1st of that year. So you take advantage of that, okay? And then the 5-year holding period ends after 5 years. And this applies to your beneficiaries as well after death. So also the spouse can roll over a Roth IRA and treat it as her own. And in either case, the 5-year holding period begins on the earlier of January 1st of the tax year your spouse first established the Roth, or January 1st of the tax year you first established any Roth IRA anywhere. All right, and here's an example of a person who's 60 years old, okay? And they established their Roth on December 31st in 2014 by converting a portion of their IRA to a Roth. Now, you must have a qualifying event and satisfy the 5-year holding period, but here, a qualifying event has already occurred. That is, they already attained the age of 59 and a half. They've also satisfied the 5-year holding period, so therefore, the withdrawal, as you can see down here, is tax-free for this particular case. Now, let's take a case of a younger person who's only age 35. Now, they established a Roth IRA on June 1st in 2014 by making a rollover from a 401k plan to a Roth, and they must have a qualifying event and satisfy the 5-year holding period as well. Now, in this case, the 5-year holding period ends December 31st of 2018, and tax-free withdrawals are available from the Roth at any other Roth you own, okay? In 2038, after you've attained the age of 59 and a half, or after December 31st, 2018, if you become disabled or die, etc., or if you qualify because of the home buyer's first-time home buyer's expense. Now let's take a case of an inherited Roth IRA. Let's say you inherited a Roth IRA from your mother in 2014, but your mother established her first Roth in 2011. In this case, the qualifying event in the satisfying the 5-year holding period is that your mother's death. In this case, you don't have to wait 5 years. Your mother passed away. Therefore, the 5-year holding period begins on January 1st, 2011, and it ends on December 31st, 2015. And tax-free qualified withdrawals are available from the inherited IRA anytime after December 31st, 2015. Okay. All right. So on non-qualified distributions, this is a case where you're under the age of 59 and a half. This is a very important point to make, is that the contributions come out first. So the way this thing works is it's FIFO accounting, FIFO, first in, first out. So your contributions can come out at any time, okay, tax-free, because it's return of principal. However, the earnings on your Roth have to be seasoned for 5 years in order for it to come out tax-free. That's a point that a lot of folks don't realize. So you make a contribution to a Roth of $7,000, and it's grown to $10,000. You can take out the $7,000 anytime and not pay any taxes on it, but the $3,000 gain has to be seasoned. Okay. These are fairly complicated rules. There's Roth conversions and there's reversal of Roth conversions. I won't go into some of that. We're experts on this, so if you ever have a question on it, you can just call us and we can give you the details. Okay? Again, here's the disclaimer, and just take a few minutes, a minute or two here to read it, and then we look forward to seeing you on the next video. All right? Take care.